Michael Saylor, the guy who runs a public company under the thesis of why own Bitcoin when you can pay me to own Bitcoin, is playing a $54 billion game of chicken. And with Bitcoin having a rough month, the guy who told us all to mortgage our homes to buy Bitcoin is all over the headlines. And here's the thing. Everyone talks about the Bitcoin spot price, but the real number that keeps Saylor up at night is 2028. That's when the maturity wall starts to hit. Saylor's company, Strategy, or formerly MicroStrategy, owns around 700,000 Bitcoin at an average price of around $76,000. He didn't buy them with his own pocket change. He used something called convertible notes. That is debt that can convert into equity. It's intelligent leverage when the number goes up, but it's a death trap when the market goes sideways or down. Because if you can't pay it back, the lender typically restructures, asking for more shares in a new note. In other words, the math doesn't math for Strategy if Bitcoin stays at these levels or, God forbid, drops from here and we experience a multi-year crypto winter. And here's why. Saylor's entire pitch to the market for his company is a simple metric: Bitcoin per share. He promises investors that every share you own will represent more Bitcoin over time. But if those billions in debt come due and the stock price is low, he can't just print more shares without ruining the thesis. If he dilutes the equity to save the balance sheet, he destroys the Bitcoin per share metric. The core promise breaks, the acolytes flee, and the stock tanks further. It's a feedback loop of value destruction, something cannabis investors from the late 2010s know all too well. He swore he'd never sell, thinking he had found an infinite money glitch. But when you're leveraged to the hilt and your asset dam breaks, time isn't your friend. It's your creditor. Godspeed, Michael.